Palantir, one of the stock market major hype trains, down a lot in the last year, down the last 2 years, just announced they were expected to make 3 cents per share. This is their press release. They were also expected to do revenue of $471 million. So their actual press release, look at this, guys. Revenue grew 26% year over year to 473. So they beat there. U.S. revenue grew 45%. Commercial revenue, 46%. U.S. commercial revenue, 120%. U.S. government revenue, 27%. Look at this. U.S. commercial customer count, 250% growth. Look at all of this growth numbers. If I were just to show this to you, what would you think about Palantir? You'd be like, this thing is sweet. Hold my beer. They were expected to generate 3 cents per share. That's what they actually did. They lost 1 penny per share. And this is kind of hard to see, but this is their press release. They lost 1 penny per share. Not only that, they're a growth company. Paul, you don't get it, they said. You don't get Palantir. It's got such a huge future. Well, next quarter, they're expected to do $506 million in revenue. They've already guided for $475. So where's the stock today? Well, let's go to our software. This is our software, our stock analyzer tool. So please follow along. We're going to put in Palantir stock. The stock is currently down 14% today, down to 986. Guys, all of that growth, it's down this much. I want you to remember something. If you're watching this and you're new to it because you were a big hypester on Palantir and you're angry, don't be angry. This is one of the best learning lessons out there. A company crushes it, but they missed expectations. That's your opportunity potentially. Now it's your job to decide if Palantir is worth 987. Because the one thing you want is when the market says one thing and you know something different. If the market misses by a few pennies, is that really going to matter in the long run? Maybe, maybe not. But if you still believe the growth story for Palantir, because Palantir has an amazing growth potential, amazing. My whole argument is stock price and company are very different things. The company can have amazing growth potential, but if you pay through the nose for it, you're wasting time and money. You're overpaying. If that doesn't make sense to you, stop this video right now. If it does make sense to you, if it makes sense to you that you can overpay for a good thing, keep watching. I'm preaching to you. And it might be a lot fewer of you, but if that makes sense to you, you're going to love this channel. Please subscribe to us. But let's go through this real quick. And I'm just going to show you some of their revenue growth, their revenue over the last, oh, well, look, we don't have much history on them. Look at this revenue growth. 650, 1.2, 1.65, and they're already on pace. If they do 475 a quarter, that's 1.8, more and more growth. Not as much growth as they thought before, though, and that's the risk with fast-growing companies. Things can stop them very quickly, just like that. But if you extrapolate out growth for a very long period of time, you can't even tell me what's going to happen a month from now. You're going to tell me what's going to happen 10 years from now? Come on, guys. That's too difficult, and things have to go flawlessly. Not only that, look at this. Number of shares outstanding have over doubled. This is not a stock split, guys. This is dilution of you as an owner. If you owned 1 share of the stock back in 2020, your share now gets you less than half of the revenue and profit before. So what does that mean? If the company's revenue and profit doubled in those 2-year period, but you own a share, you got no benefit. Because now the revenue and profit's been split amongst more owners and you're getting the same amount of money you did before, even though the fundamentals of the company got better. Why do they issue more shares? Well, if stock is very overpriced, why issue debt? Give the overpriced shares out to the market, get the cash for free, and when the stock plummets, you don't owe anybody anything. That's way better than taking on debt. That's why they do it. But the unfortunate part is nobody looks at this bottom line down here of shares outstanding. That's the silent killer to investing. That's what Palantir has done. Do I blame them? Absolutely not. They're just giving the public what they want, which is more and more shares. But look at the stock price. It's no coincidence. This company has a ton of growth potential. It hit $40 a share here, $39 a share in January of 2021. And now it's at $9. It got as low as $6.44 recently. Guys, if the company's growing like crazy, it should never go down according to the hypesters, right? Ever. I'm here to tell you, we don't know what's going to happen in the short run. The short run, stocks are a voting machine. In the long run, they're a weighing machine. In the short run, right now, everyone hates Palantir. In the long run, what's the company going to do fundamentally? So let's use our stock analyzer tool, the most popular part of our software, to determine what to pay for the company. Now, the only downside of the tool is it doesn't factor in stock repurchases or issuance. So it's going to be based on the number of shares outstanding staying the same, which we've seen that they kind of have an addiction to issuing a lot of shares. So let's go right here. I'm going to do a 10-year analysis because I'm a big fan of Peter Thiel. I think he's going to be around for a long time. And this company, he's the one who did PayPal with Elon Musk. He was one of the early investors in Facebook. He's a brilliant man, libertarian. I love him. We don't agree on crypto, but that's okay. So revenue growth. Let's do 10, 20, and 30% revenue growth a year. Profit margin. Guys, here's the problem. We have no clue because they haven't made money. But let's go typically with software businesses. 15, 20, and 25 is still being conservative. We'll do the same for free cash flow. PE. I still think they have growth potential afterwards. So I'm going to go 14, 16, and 18 on both PE and price to free cash flow. But I'm going to go on a 15% annual return that I want. The higher the annual return I want, the lower the price will be. Why am I doing that here? Guys, young companies that are so unknown, look how much data we have. We don't have any data. The company hasn't made money. I have to sit there and make a lot more assumptions and give myself more margin of safety, and that's what I'm doing here. So I'm going to hit the Analyze button. Once I hit the Analyze button, which I just did, there are 6 numbers going to come before. When you see these numbers and you want to understand this again, please rewatch this video. This is very important to understanding how you value a company from a 500-foot view. If the numbers are all green, that doesn't mean go buy it. It means go do more research and make sure these assumptions are spot on. How can you do that? The Goog, get pro and con articles to Palantir, but more importantly, go to our community. Just join. It's month to month. It's less than a cup of coffee per day. You can go in there and talk to anybody in there. There are thousands of people here active every single day. Talk about Palantir, and they will preach and preach and preach the pros and cons. There are people in here who love crypto and Tesla. I'm anti-crypto. I think Tesla is massively overpriced. There's a community of people for everything there. So if it's all red, if it's close though, but it's all red, still do more research and get ready to buy it when the price hits your target. So I hit the Analyze button. Boom. High level, if you believe all the high assumptions, $16.50. If you believe all the low assumptions, $2. Middle assumptions, about $6. So that's where I stand on Palantir. It's just math. If you like this video, want to understand more about our 8-pillar process, watch the next video above on that 8-pillar process, and don't forget to subscribe to our channel. Thank you very much for our time.